I was asked to testify today on certain aspects of the role of hedge funds in the financial crisis. I also have submitted written testimony, which provides more detail and background. There are three important findings I would like to share with the committee. First, hedge funds did not cause the financial crisis, and are in fact helping to reduce its damage and save taxpayers' money. This may seem surprising, but in fact hedge funds have historically made markets more stable and have helped their investors conserve wealth in times of economic stress. In other words, hedge funds are often less risky than mutual funds. A typical hedge fund strategy seeks to achieve higher risk-adjusted returns, but not necessarily higher returns than other investment vehicles. And in fact, throughout this crisis, hedge funds have conserved wealth much better than mutual funds have. Second, short selling by hedge funds has helped draw attention to the poor investment choices made by financial companies in recent years, but did not cause them to collapse. When hedge funds short sell the stocks of unhealthy companies, they help to divert capital from companies that are fundamentally unstable. This not only prevents stock market bubbles from becoming worse, but it helps to ensure that companies that are making good decisions are rewarded and are better able to provide stable, long-term jobs for their employees. Third, existing laws and regulations should be strictly enforced against hedge funds and their managers, and these include laws prohibiting fraud, insider trading, abusive short selling, and other types of market manipulation. But changing how hedge funds are regulated could actually undermine the interests of investors and heighten economic instability. While it may be easy to lump hedge funds together with the financial institutions that were directly involved with this crisis, we must be very careful to make the appropriate distinctions to ensure that policy responses to the crisis do not undermine the ability of the economy to recover. So what is a hedge fund? A hedge fund is a private investment company that makes frequent trades in stocks and other financial instruments and compensates its manager in part with an annual performance-based fee, typically 20% of profits. Hedge fund managers also typically invest in the funds they manage. This compensation agreement leads hedge fund managers to strike a relatively healthy balance between risk-taking and risk management, and as empirical research has found, to make the survival of the hedge fund a greater priority than earning performance fees. Now, it may come as a surprise to some, but hedge funds are not even actually a part of corporate America. Hedge funds often take aggressive action against company executives they think are paid too much or are not properly running their companies. Importantly, when hedge funds get other companies to more properly manage their businesses, hedge funds help those other companies provide more stable jobs for their employees. Now, the financial crisis is the result of distortions in the mortgage and banking sectors, and would have happened even if hedge funds had never existed. Indeed, hedge funds were never the major purchasers of mortgage-related securities. The major purchasers were banks, insurance companies, pensions, and mutual funds. The most meaningful role hedge funds have played during the financial crisis has actually been to dampen its cost to the economy. Large numbers of hedge funds, worth a total of approximately $100 billion, have increasingly been purchasing poorly performing assets, such as mortgage-backed securities, and are helping to reduce the need for economic bailouts funded by taxpayers. Indeed, just yesterday, the Treasury Department announced that it may start requiring companies that receive government funds to first raise private capital. Many hedge funds may be poised to provide such capital, as a recent estimate found that the hedge funds are currently holding about $400 billion in cash. Given the massive losses that have resulted from the financial crisis, our system of financial regulation certainly needs rethinking. Yet based upon the empirical evidence, changing the already substantial body of law applicable to hedge funds will not stop this crisis or prevent another one from happening. Instead, lawmakers and regulators should focus on two things. First, economic recovery may take place more quickly if lawmakers make it easier for hedge funds and other private investment funds to invest in banks. Second, lawmakers and regulators may want to take a look at making it easier for ordinary investors to have access to the investment strategies offered by hedge funds. For example, reducing the restrictions on mutual funds investment activities may be a way for all investors to benefit from the protection that hedge funds provide, and not just the rich ones. Thank you very much for the opportunity to share my research with the committee.